Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes.
All right. Good afternoon, everyone. Welcome back to my Tuesday session. My name is Lakshay. I am an accountant operating out of two offices in Ontario, Mississauga and Brampton. If you guys have any questions in regards to accounting, bookkeeping, or taxation, I am your guy. You can feel free to, watch any of my recorded sessions on YouTube, my YouTube channel, Real Estate and Taxes, if you've missed any, or you can even book an appointment with me if you have any questions in regards to your personal accounting as well as your businesses. So without further ado, let's get started with today's session. Today, I wanted to focus on, is restaurant business profitable in Canada? A lot of you guys might be restaurant owners. I see a couple of people who are in the business of operating a fast food chain, and I would be looking for your help in terms of today's session in participation as well. So without further ado, let's get started. Today's agenda is first we're going to talk about what are some of the steps involved in opening a restaurant. Then we're gonna talk about 3 live businesses and their profitability. And then we're gonna finally conclude by comparing the 3 and a little bit of a taxation point of view as well. So steps to opening a restaurant. Well, number 1, first and foremost, whenever you're getting a restaurant, we all need to lease a premises. Even though the premises is already leased to a restaurant from the past, you still wanna do your due diligence and check. There has been instances where the zoning requirement has basically caused the business to not operate. Even if it's a restaurant before, doesn't mean the zoning allows it to be operating as a restaurant. So the first thing first, whenever you are opening a restaurant, you want to check if the premises allow it to operate as a restaurant. Followed by, what business structure should you be using in order to incorporate your business? There's a few types of businesses that you can operate from. If you're operating as a bakery from home, for the first 30,000, because you are probably the only employee, there's not a lot of hazardous chemicals or hazardous materials or machinery at home. So even a sole proprietor with the first $30,000 of income can work as the right business structure for you. But as soon as you operate as a restaurant outside, you'd want to focus on incorporating your business. This is the type of business structure which allows you to limit your liability. So if someone was to get poisoned from the food, or some slip and fall on your premises, or any of those sorts of things that you want to stay away from, you would want to focus on incorporation business structure, because that is limited liability and you protect your personal assets whenever there's any sort of mishappening. You can, as soon as you want to incorporate and you have the name in mind, what I would recommend is getting a trademark for the name as well as the domain name. Because if you open a business without registering the domain name, someone can steal that name and then start operating that business with the same name, and it can become costly. Now let's look at the municipal level. Every province in Ontario has its own laws, and every province has different municipality. So what I highly recommend is looking into that municipal website in order to see which type of business you're doing, and then applying for those licenses. Make sure to start well in advance. Planning your team in advance is very important as well, because at the end of the day, you need someone to cover the night shift, the evening shift. You can probably do 1 out of the 3 shifts, right? From 9 to 5, or usually restaurants have 7 to 3, 3 to 11, and then 11 to the morning. So 3 shifts. You would want to plan your team in advance. When it comes to taxes, I would highly recommend from day 1, when you register your business, get registered for the HST as well. Now let's look at a profit and loss of a company that is operating on a franchise level. It's a franchise business where the sales are roughly $500,000 and they have some other revenue. The total sales were $501,000. On this number of sales, typically, the cost of sales for a food business should be hovering around 30%. But in this scenario, you can see the cost of sales is a bit high. It seems like, it might be a restaurant where Indian spices are being used, because Indian food requires a lot more, spices and all additional overhead expenses that a normal sandwich might not require. When it comes to expenses, if you look at it, they netted out to $291,000 of total expenses, which includes your own salaries, your royalties, your rent, and all the other expenses that you have to operate the business successfully. Usually, net income should be netting around roughly 2 to 6%. In this scenario, even after doing $500,000 in gross revenue, they're still at a loss. Why? Because some of the expenses where it seems like the salaries and wages, they're not being controlled nicely. In this scenario, if you wanted to look at a franchise restaurant which has royalties, which has high rent and high wages, my recommendation technically is to control your salaries and wages. My assumption is you also have family members, and in this scenario, because the salaries and wages is $150,000, the net profit has basically become a net loss of negative $40,000. And my recommendation would be to control these salaries by, instead of employing outsiders, put that payroll on your family members to bring the negative to positive. So now let's look at a catering business. In the franchise business, basically the cost of sales was 50%, but in the catering business, this is more like you don't have to order food from the franchise owners. You don't have to have furniture. You don't have to have a lot of the other things that and dine-in restaurant needs to have. That's why the cost of sales is a little bit lower, which is 20%. Typically, this should be hovering around 30%. If we look at the catering business, total revenue was again $500,000 on $500,000 of total sales. They had lower rent, salaries and wages, and because they had controlled their other expenses in a good manner, they were able to pull out $100,000 in management salaries. Even then, they're coming out as a winner in this scenario. Why? Because this is technically being run on a very low operating cost. By that I mean there's not a lot of dining, so you don't need a lot of staff to clean the tables and service the restaurant. Catering business, the orders come in pre and then you prepare, so the food cost, like the wastage is very low. Royalties is 0% because it is being done by the owners themselves, and there is no franchisee model in this scenario. Then we have the salaries and wages is roughly 28%. Typically, this is 1/3 of the total revenue. This is also 1/3 of the total revenue. And the remaining 1/3 goes to other expenses. They have maintained it very well, and they have kept the revenue in line with the other businesses, and that's why they're coming out as a net 18% profitability. Typically in restaurant business, the profitability is hovering around 2 to 6%, but in this scenario they're doing really well, just because in catering business you get the contract logged in before you start preparing your food, and the costs are a little bit more controlled. Now let's look at number 3. Number 3 is family owned restaurant. In this scenario as well, the top line was $500,000 in revenue. Then we have other expenses, and again the net income is very high. As you notice, we move out from franchise model to catering business, from catering business to family owned restaurant. In this scenario, the cost of sales is a little bit higher than the catering business, because this one is more intensive in terms of having people sit down, dine in. The salaries and wages, they were able to control to 20% of total revenues. How? Because they're, again, husband and wife were working full-time in the restaurant. So this is one of the things that is in the hands of the business owner. So highly recommend looking at your salaries and wages or the labor costs to have a good idea on good control on your business. The royalties again is 0% in this scenario because it is owned by the family and there is no franchisee model. Then we have the net income, which is 25%, and which works out to roughly good amount of revenue left even after all of the expenses. And when it comes to rent, they basically have had the restaurant rented for 20 years, so the rent is very low because they locked in at a very good deal back in the days. Salaries and wages, this includes just 2 additional employees, and they are withdrawing management salaries of 40,000. Once again, very well managed restaurant because they are able to basically reduce all of the additional expenses there might be. So once again, the lowest profitability was franchisee business because the food cost was not being controlled, the rent was not controlled, and as well as the business owner was not actively involved. The second business was catering business. Again, the business owner was involved but not 100%, so the profitability was a little bit lower, but because there was no royalties and the overhead the wastage of food was less, they also came out as a winner and making money. But the best one in my scenario worked out to a family-owned restaurant where the labor expenses were so low that the profitability became very high because the family was actually actively participating in the business and bringing the total cost of all the other things and controlling it as well. So cost of sales, once again, 1/3 of the business is typical. Salaries and wages is typically 1/3 of the business as well, but in this scenario they controlled it to 20%. Royalties are 0 and net income is working out to 25%. All right. Thank you very much for joining in today. We'll see you next Tuesday on a brand new topic. If you have any suggestions, feel free to text me those, and I'll be more than happy to accommodate those.